Welcome. Today we're taking a deep dive into Subway. It's a really interesting situation, this huge contraction happening in the US, while at the same time, they're still expanding globally.
Exactly. So we'll dig into the numbers behind that, look at why so many US stores are closing and, what Subway's doing about it, especially under their new owners.
And we'll also touch on the human side of these closures too. It's important.
Definitely.
Okay, so if you find this kind of in-depth look valuable, please do take a moment to like and subscribe. It helps us keep bringing these analyses to you.
So let's start with the US picture. Subway is technically still the biggest fast food chain here by store count.
Right, by the number of locations,
Yeah.
but that number is shrinking, and quite significantly.
It is. In 2024, they saw a net closure of 631 restaurants in the US.
Wow, 631. So where does that leave them now?
That brought the total down to 19,502 by the end of 2024, which is actually their lowest count in about 20 years.
20 years. And this isn't just a blip, is it? This decline has been happening for a while.
Yeah, it's been ongoing for the last 8 years, started back in 2016.
So since 2016, how many have closed in total net?
It's around 7,600 net closures in the US since then. It's quite a drop.
That really puts it in perspective, especially when you think they peaked at, over 27,000 stores not that long ago? Sometime around 2013 to 2015?
Exactly. So you're looking at US franchisees closing roughly 28% of the chain's locations in less than 10 years.
28%. That's huge.
It is. But, despite all that, they still have the most locations overall in the US.
Which is kind of amazing. But store count isn't everything, right? What about revenue?
Well, that's where it gets interesting. In 2024, McDonald's was #1 in U.S. revenue, even though they have fewer stores, around 13,500, maybe a bit less.
Okay, so McDonald's is third in store count, but first in revenue. Who's second in stores?
Starbucks has the second most locations, somewhere between, say, 16,300 and 16,900.
So Subway has the most doors, but maybe not the most profitable doors on average.
That seems to be the implication, yes. Lower average unit volumes compared to some others.
Okay, so let's get into the why. Why are so many U.S. Subways closing? What are the big factors?
Well, one major thing you hear about is overexpansion. Back in the 2000s, they franchised very, very aggressively.
Where you'd see them popping up everywhere,
Yeah.
sometimes really close to each other.
Exactly. And that led to oversaturation in a lot of markets. Stores started, cannibalizing each other's sales.
Taking business from the Subway down the street, not necessarily bringing new people to the brand overall.
Precisely. And that really hurt the profitability for individual franchise owners.
Okay, overexpansion. What else? I've heard things about franchise relationships.
Yes, that's definitely another piece of the puzzle. There's been quite a bit of franchise frustration, even disputes.
About what specifically?
A few key things. High royalty fees, often around 8% of gross sales, even if the store isn't making much profit.
8% regardless of profit. Ouch.
Yeah. And also being forced to participate in deep discount promotions like the old $5 footlongs, which could hurt margins, plus a feeling of lacking control over their own marketing and pricing.
So they feel squeezed from multiple angles.
Pretty much. And some franchisees have actually sued the company over these issues. It's led to, some operators just getting disillusioned and deciding to leave the system.
That makes sense. Then you have the broader economic factors, I assume. Costs, inflation.
Absolutely. Especially post-pandemic. Ingredient costs shot up. Labor shortages pushed wages higher.
And rent, presumably.
Rent, wages, food costs, the whole package just made some locations unsustainable.
Yeah.
And you mentioned California earlier, that $20 minimum wage there definitely impacted margins significantly for operators in that state.
On top of that, rising fees from corporate, mandatory remodels, adding costs.
Yes, those add to the financial strain on franchisees too. It all adds up.
And competition. The sandwich market feels more crowded now.
Oh, definitely. You've got chains like Jersey Mike's, Firehouse Subs, Jimmy John's, Potbelly.
Yeah. Which are often perceived as maybe fresher or more premium.
That's the perception for many consumers, yeah. They're seen as offering higher quality, more customizable options, and that's eroded Subway's market share, especially as people look for, something a bit different or perceived as better quality.
It feels like Subway's brand image might be a bit stuck, too, despite efforts to change.
There's an element of that, perhaps a brand identity crisis or some consumer fatigue. Past controversies haven't helped their reputation.
And the whole eat fresh thing, the $5 footlongs, maybe they just don't resonate the same way anymore.
It seems like consumer expectations have shifted. People want more customization. They want to know more about ingredients, value beyond just the lowest price point. The old messaging feels a bit dated to some.
And sometimes their promotions didn't quite land right.
That's true. There was that $6.99 6-inch meal deal in late 2024. It didn't boost sales as they hoped.
Really, even after testing.
Apparently, it met expectations in testing for daily redemptions. But in the national rollout, it just underperformed and they pulled it pretty quickly. Shows how tricky those big promotions can be.
Okay, so a lot of challenges, but there's new ownership now, right? Roark Capital.
Yes, the acquisition finalized in, well, either 2023 or 2024, reported price tag around $9.6 billion. And Roark has a lot of experience in the food and hospitality space.
So what's the plan under Roark? Are they just managing the decline?
No, not at all. They're implementing what they call a smart growth strategy. It's a pretty comprehensive transformation plan.
Smart growth. What does that mean in practice for the U.S.?
It means optimizing the footprint, using data to be much more strategic about where restaurants are located.
Making sure they're in the right spots with the right image and format.
Exactly. And run by the right franchisees, the ones who are strong operators. It involves opening some new stores, maybe relocating others.
And closing the underperformers.
Right, closing the ones that consistently drag things down. It's that shrink to grow idea.
Cut the weaker links and reinvest in the stronger ones.
Precisely. And a big part of that reinvestment is modernizing the stores. You've probably seen some of the newer designs.
The Fresh Forward 2.0 looks quite different, more modern, brighter.
Yeah, that launched late 2023, more vibrant, trying to amplify the brand personality. By late 2024, they had already remodeled or built over 20,000 locations globally in that new image.
Including over 10,000 in North America. That's a lot.
It's a major push. They're also investing heavily in digital.
Okay, like what? Apps, delivery?
All of that. Better app-based loyalty programs, partnerships with delivery services, exploring digital-only ghost kitchens.
Ghost kitchens. Interesting. So just for delivery orders?
Potentially, yes. And also providing better performance tracking software for franchisees to help them manage operations. Driving people to the app and website is key for their loyalty efforts, too.
So improving the stores, improving the tech. What about the food itself?
That's also a focus. More customization options, really pushing app orders for convenience. And the big one, introducing freshly sliced meats in stores.
Ah, yes, the slicers. That was a big change. Trying to combat that fresher perception from competitors.
Seems likely. And they're innovating with other items, too, like those foot-long cookies and the Doritos foot-long nachos. Trying to create some buzz.
And bringing back deals, but maybe more strategically, like that $6.99 foot-long deal in May, but only for digital orders.
Exactly. Using promotions to drive specific behaviors, like using the app.
So while all this contraction and transformation is happening in the U.S., what about internationally? You said they're expanding.
Yes. Globally, the picture is quite different. They've actually had positive net restaurant growth worldwide for the last 2 years running.
Really? So more opening than closing globally?
Correct. They have nearly 37,000 locations worldwide now, which makes them the third largest global restaurant chain overall.
Third largest globally. Where are they focusing this international growth?
Key markets include places like India, China, Latin America, the UAE, Saudi Arabia, big potential growth areas.
And they expect this trend to continue.
They anticipate